Good evening, friends. On behalf of Phillip Capital, now I invite everybody to the Q4 and FY18 results con call of Camlin Fine Sciences. We have with us Mr. Ashish Dandekar, Managing Director, Mr. Nirmal Momaya, Strategy Director, and Mr. Santosh Swaram, Chief Financial Officer of the company. So they will now discuss the brief numbers initially, and subsequently we can have a Q&A session. Now over to you, sir.
Good evening. I'm Ashish Dandekar here, the Managing Director. I think we'll first give you a brief of the performance and the figures, after which we can always engage in a question and answer. Over to you, Nirmal.
So basically in this quarter, Q4, we've seen a start of a turnaround as anticipated. On a consolidated basis, our EBITDA margin is about 18 crores on a top line of 231 crores. What we are seeing is that our blends business has started contributing in this quarter. We've grown by about, what is the percentage of growth? 50. About 45% we have grown in our blends business. We were at 132 crores in the last financial year for this quarter. Of the corresponding quarter is now, for the last year was 132 crores. For this year it is 203 crores. So we've grown 34% in the year. But for the quarter, our growth in the blends has been, I'll just tell you. We have grown from the blends business from last year by about 30%. This year we are at 52 crores for the quarter. So the total the shift that is happening is in our shelf life solution business is that we are growing in the blends business. Our base straight business has remained more or less constant for TBHQ, BHA and ascorbyl palmitate, but the growth is coming out of the blends business. In the aroma business, we have for this quarter, for this year, as compared to last year, we have increased the sales by about 70%. From 23 crores, we are now at 109 crores. For this quarter, we are at, we have done about 46 crores, which corresponds to almost the same number which was there in the last quarter. The vanillin business is stabilizing now. We are making entry into the developed markets. We have started sales more or less in most countries, though of course it is at a smaller level. Our capacity utilizations are under 60%, but I think going forward in this year we should be able to add another 10-15% to what we are doing right now to take it up to about 75% of capacity, 70 to 75% of capacity utilization. And the performance chemicals business also has seen a slightly better business as compared to last year, full financial year. We've grown it by about 12.5%. Which also, of course, includes a small part of the business that we've started with Lockheed Martin, but that's a very small percentage. We basically have grown in the downstreams of hydroquinone and catechol, where we have grown in TBC. We've seen a growth of about 20-odd%. We've seen growth in guaiacol, naturally because of the vanillin business. There's been a substantial growth in the guaiacol business, and MEHQ and CME as well. These are the two products where we have seen a very reasonable and substantial growth. Going forward, we see that for hydroquinone, the prices in this current year seem to be improving now, and we expect in the next couple of quarters, for the next couple of quarters at least, the prices of hydroquinone to remain strong, which should help us in improve our margins from our Italian operations as compared to what it was in the corresponding period of last year. I think with this, we've given you an overview on what the operations of this quarter have been. Our gross margins have also improved as compared to corresponding quarters on a standalone basis as well as on a consolidated basis. We've seen margins improve by about 3% on a consolidated basis. Also, we have on a consolidated basis, on a deferred tax, we have had a hit of about 4 crores as compared to in the last quarter, which is why the deferred tax amount is slightly higher than what it was in the previous 2 or 3 quarters. So that has impacted the profit after tax. But on a consolidated basis, we have turned around and shown a profit of 5 crores 34 lakhs versus a loss of 8 crores 32 in the previous quarter. And in the corresponding quarter of last year, we were at a loss of 668 lakhs. So I think with this background, we'd like to take questions and answer any specific questions that you have on the business.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may please press star, then 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star, then 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star, then 1. The first question is from the line of Mitul Mehta from Lucky Investment Managers. Please go ahead.
Yeah, hi sir, this is Mitul Mehta, sir. Can you hear me?
Yes, sir. Yes. Please go ahead, Mitul. Please go ahead.
Hi. So, when I was going through your result does mention about another enabling resolution or a QIP that you intend to do another round of fundraising of up to 250 crores. So, one is I want to understand as to why this QIP.
Okay. So, no, it's not a QIP. What we are taking is an enabling resolution for raising finance. In all likelihood, it will be debt. What has happened is currently looking at the banking issues with especially the PSU banks, to raise money or debt for our projects is becoming a challenge, especially with the Dahej being executed. We have a requirement of about 100 crores of debt for executing the Dahej project, as well as we have Lockheed Martin and some other projects in the pipeline for which we need to finance them. So we've raised the equity portion through the QIP, but there is the debt portion which is yet to be funded. So we are in talks with some institutions for raising debt from them in the event we don't get money from the PSU bank. So that's really what we've taken an enabling resolution. Of course, there is some mention of some equity in that, but the idea is not really to go for any equity raise. It is predominantly it should be a debt raise.
Oh, so, if we cannot get the debt at the right interest rate, then obviously we will have no option but to raise equity.
Yeah, so we'll have to see. Really, we are in the process of evaluating what we should be doing, but since we don't want to delay our project in Dahej, we're saying let us take an enabling resolution. Whilst we are negotiating with the public sector banks, we don't know, really, as we stand today, it's very, very extremely difficult to say how long they will take to give us approvals.
Sorry if I may sound a little crude, because what I have seen in Camlin is time and again, we come to the market and raise equity. So is there any sort of a financial discipline on the part of the management? Because what I see in your balance sheet also, your investment schedule has gone up from some 15 crores to 100 crores. So obviously, somewhere you have invested in some subsidiaries here and there. So can you also give us the breakup of that? Because time and again what we understand from Camlin is that we keep on raising equity, we keep on, so where are we going to end this now?
No, so the idea is not to raise equity. As far as the investment number is concerned, Santosh will explain.
The investment from year to year has happened. As you know, we had acquired vanillin business and for the working capital for that. So on a consolidated standalone basis, the investment has predominantly increased because of the investment in
Mexico and China.
Mexico and China, which is around 100 crores. So that's what has increased in the investment schedule. Apart from that, we have not invested. As a standalone, as we had raised QIP, we had said in QIP that we'll be recapitalizing certain capital to our existing subsidiaries to reduce their dependency for working capital from us. So those are the investment. We have not gone for any other investment than the investment which you already know.
Sir, anyway, that is up to the board to decide, but, we as a shareholder would rather want to see the numbers first and then, there should be a meaningful or whatever fundraising happening from your end. So, that's about it.
Okay. Noted.
Thank you. The next question is from the line of Sudarshan Padmanabhan from Sundaram Mutual Fund. Please go ahead.
Yeah. Sir, I would like to get some color on the subsidiaries, especially the ones, in China, the blends in Brazil, US, Dresden, and CFS Europe. What are the sales that they have reported in FY18 and how they have performed on a year-on-year basis?
Okay. So CFS Europe is a substantial subsidiary. In FY18, we had a turnover of 277 crores with a negative EBITDA margin. This was due to the fact that in the first quarter, we had an extensive shutdown for every 10 years in Italy. The regulation is that we have to get our plant recertified, which takes a certain period of time for the regulators to come and certify the plant for the next 10 years from a safety angle. And this we had explained in the past that in the first quarter, the big loss that was there was because the plant was shut for almost 50 days. And by the time we restarted and stabilized, it took us, almost the first quarter was lost in that. As compared to FY17, it was 222 crores on a standalone basis, the CFS Europe. So it has grown by about 25% or so. What has impacted us in Europe in this year was also the currency, because euro was had become very strong compared to the dollar. It was almost, I would say, the impact was more than 10 to 12% in the year. Since we buy in euro and we produce in euros and we sell in the dollar markets, that with the euro becoming stronger, that impacted our margins. However, we are seeing that the euro in the current year is weakening against the dollar, so which should also give us some support in the current year. Then to the next operations, we'll go to CFS, our subsidiary in Brazil. That the turnover for FY18 was 25 crores as compared to 17 crores in FY17, so which is a annual growth of 46%. Our gross margins there have improved from 16.5% to 27.5%, and they further will improve in this year. They will probably go to about 35% or so in the current year. The EBITDA there was a negative of 4 crores as compared to a negative of 5 crores in the last financial year. Predominantly, we had a large foreign exchange loss in the last quarter of about 2 crores, which impacted the numbers in FY18. But in FY19, we are seeing that the turnover will grow, gross margins will improve, as well as the currency has now started stabilizing against the dollar. It has become weaker against the dollar, and which will help us in improving some of the margin. So we expect Brazil to be positive in the current year. Then the next is CFS, our North American operations. So there the turnover has increased to 17.8 crores versus last financial year of 10.86 crores. There the gross margins are in the teens, mid-teens, purely because it is yet the blends business has not really taken off as yet in the current year, in FY18. It is more of reselling of the straight. So the margins are subdued because of that. It's the blends business which gives us the 35 and the 40% gross margins. So we expect, I mean, this year we had a negative of about 12 crores versus a negative of more or less what it was the last year. We expect in the current year, by the end of this year, we should, because of the businesses that we are lining up right now on the blend side, we should be breaking even on a run rate basis by the end of the year. That's the expectation for North America. For Mexico, we grew the business from last year, the turnover was 120 crores. We grew it to 164 crores, so which is about 30% growth. There the gross margins are about 43-44%, and the EBITDA margin is 17.5 compared to 20.5 of the previous year. That also again got impacted because of the foreign currency change in the last quarter. So we saw that impacted us by about 1% or so, 1.5%. This business in the current year should grow at about 30%. That's what we have targeted, and we should be crossing the 200 crore mark in the current year with a EBITDA margin of between 18 to 20%. Then China, we did a turnover of 88 crores. Of course, it was zero in the last year. We have a small EBITDA of 91 lakhs, giving us about 1%. Purely the capacity utilization in the 6 months is at about 60%. Of course, we had expenses for 3 months when we were in a shutdown from July onwards for the maintenance and restart of the plant after we took over. So that also impacted the EBITDA in those 2.5 months. But in the 6 months, we are above break even in the business with the 60% capacity utilization. These are the principal subsidiaries and their operations.
Yeah, sure. Last year we had been impacted primarily because of our business rearrangement, in sense that we wanted to move out of moving through a distributors. So we basically got impacted by a couple of distributors moving away. Now, how is the environment looking, sir? I mean, are we getting business from the companies which are directly going and pursuing?
Yes. So our blends business in FY17, which is the business that we were recalibrating, was 132 crores, which has this year in FY18 we've gone to 200 crores, showing a growth of about 50%. So we expect to maintain at least a 30% growth in this business in the current year.
But yes, to answer your question, we are seeing the transformational changes.
Sure. So just one last question from my side. I mean, you had even now talking about raising debt for in the operations that you mentioned. I mean, what I would like to understand is as now that the capacities are in place and probably we have been with this business for quite some time and things are shaping up. So in terms of the peak debt, where do you think, number one, the peak debt will settle, and number two, eventually one would also expect the cash flows to start coming into the business and the capex cycle to turn down. So I mean, when do we start seeing that cycle of lower capex and higher cash flows coming into our business?
In fact, we haven't done any capex in the last 3 years, any significant apart from small maintenance capex. In the last 3 years, we did 2 acquisitions, which of course raised our debt by 100 crores, but it gave us the Mexico business and the China business. what currently we have started our project. That's the first real project of CapEx after probably 3 to 5 years, where we are expanding our, setting up a new capacity rather, or expanding our capacity of hydroquinone and catechol in Dahej, which is where the large CapEx is planned for. Also, we have some downstream products of from Dahej, especially on the Lockheed Martin and some of the other products that we've on the downstreams that we have planned for. So the CapEx for those in the future, I would say this cycle will continue for about 1.5 to 2 years, where we will finish our CapEx cycle, which is about 230 to 240 crores is what is envisaged as the total CapEx over the next 18 months. As far as the debt, to bring down the debt, it's only FY20 when all these CapExes start throwing up cash, because all of them are substantially, either they are for cost saving and some of them are for additional businesses. We would be in a position to start paring down our debt.
So thanks a lot. I'll join back.
Thank you. The next question is from the line of Samir Shah from ValueQuest. Please go ahead.
Hello. Hello.
Yeah.
Yes. Two questions. One is, if I do consolidated minus standalone, so first on the consolidated numbers, the other expenses have gone up considerably. So last 2 quarters, from last 4 quarters is 40 crore, 47, 60, and now 69. So what is this other expense? 70 crores for the quarter.
Majorly, the China has come into the picture, so the other expenses has increased in this quarter because of China fixed cost. As we are telling that in consolidated basis, we incurred around 3 crores of foreign exchange loss in Mexico and Brazil, which has contributed to around 7.5 crores increase in the other expenses.
Okay. And if we do, say, consolidated minus standalone, then the margins have dropped significantly. I mean, EBITDA has, gross margins have also dropped, and subsequently EBITDA has also dropped.
Yeah.
What can we attribute that to? I mean, international operations, which did a 13 crore EBITDA last quarter, has done 1 crore negative EBITDA.
So 13 crore last quarter?
So I am doing consolidated minus standalone.
Okay. No, I don't think you can look at it that way, because in the standalone, in the consolidation, what happens is any cross goods across selling from one entity to the other gets cancelled.
Right.
Whatever my stock is on the water, whatever I've shipped from here, from India to all my subsidiaries, so you really cannot, it's not really, comparable. So
for example, in March quarter itself, there was material, we had to eliminate revenues of around 100 crores because the material moved. It has been sold at one location, but may have not been received at the other location, or after receiving, they have to process and sell it. So there is an elimination of sale which happens, and obviously there is an elimination of margin on that sale happens. So if sale happens, because sale is not is as per the business needs and not as per the quarter end or something like that. So if large sale happens in the later part of a quarter, then there is likelihood that it remains. Like for example, in this quarter there was 90 crores rupees of sale which got eliminated as against 70 crores in the last quarter. So the margins get impacted because of that.
Okay, so but then say on a say quarter basis, consolidated EBITDA margin is 4.5, which we are saying will become 10 next year.
Correct.
So in terms of run rate, are we on track, or there is a slight dip because of some forex or these some other reasons?
No, so I think 8 to 10% is what we have guided, and I think as we stand right now, it seems that we should be getting to that number, of course, subject to currency holding the way it is, and what we are seeing in the market for hydroquinone especially, it's become, the prices have become much stronger than they were in the corresponding period last year. So our Italian operation should give us a decent operating margin this year.
Right. So basically, if currency remains where it is currently, then there is no problem.
Correct.
And the prices of hydroquinone.
And hydroquinone, we are seeing that for the next few, at least for the next two quarters, it should remain where it is.
Right. And last question is on, again, QOQ. If I see depreciation and other income, there also there is a significant increase, and interest cost is 4 crore, whereas debt has not gone down. So this part also we are not able to understand.
The debt, actually the cash rate has gone down in the last quarter. So we were at an average cash rate of around 210 has come down substantially less, down to 170 crores. So there was a saving because of that. The other income, as you know, we have this QIP, which has the money which pending utilization has been kept in the mutual fund to the tune of around 110 crores on an average, which is yielding us 7.5% return on mutual funds. So mark to market of that, we have invested in growth, but mark to market is to be accounted. So that has contributed.
But this, for 100 crores, that 7.5 will be annual interest, whereas this is, in a quarter itself, 6.5 crore is the...
Another aspect is that the way the accounts are made, if there is a gain in one quarter, then it goes under other income, but there is an expense, it moves back to the other expenses. So, overall basis, in one quarter, I may have a 5 crore other income because of foreign exchange gain, but in the net, this foreign exchange gain, if becomes negative, then the entire other income goes in the next quarter and gets debited as an other
expense. Okay.
So this is a grouping problem, and IFRS doesn't allow us to. If there is a negative, it has to be shown under other income, and otherwise, that is not an other income as such. It is a revenue income, but the accounting doesn't allow us to do it.
Understood. And depreciation also from 5-6 crore run rate has gone to 9.78 this quarter.
Because of unconsolidated.
Yeah, consolidated, because I don't think there is any, capitalization in this quarter.
Unconsolidated.
The depreciation and amortization on consolidated,
9.78. Last quarter was 6 crore, before that 6.3, before that 4.5.
This amortization.
This is because of IFRS, some amortization on consolidation. On consolidation, this IFRS has been done, so there was some fair valuation done, and there is a charge of 2.5 crores coming.
So, but in terms of, say, next year's depreciation will be 40 crore or 26 crores, apart from whatever new capex we do?
This is a transitional provision, so next year it should be in the range of 32 to 34 crores.
All right, sir.
Thanks. Capitalization, if something gets added, project come, then of course.
Yeah, that will obviously add to it. Right. Thanks, I'll get back to the queue.
Thank you. The next question is from the line of Rohit Khanna from Emkay Global. Please go ahead.
So this is Rohit Khanna from Emkay Global. Thank you for taking my question. So I just want the clarification on the currency impact on on quarterly basis as well as on the full year basis.
Consolidated, we had a net gain of around 1 crore rupees. On a quarterly basis, in this quarter, we had a net debit of 1.5 crores.
So also on this quarter, on console we have 1 crore gain, right?
1.5 crore loss.
Okay, 1.5 crore loss.
Consolidated basis. In India, we gained. We lost in Brazil and
Okay. Okay. And sir, since you have given the breakup of all the subsidiaries for the revenue were for the full years, so is it possible to give the breakup on the quarterly basis also?
the revenue. Turnover of CFS Europe for the quarter Q4 was 84 crores.
That is Europe, is 84.
Brazil was 6 crores. North America was 5.2 crores. Mexico was 39 crores. And China was 55 crores.
Sir, Mexico was?
39.
Okay. Okay. And sir, since crude prices are going up, so how that will be coming into our picture as raw material prices?
So phenol prices generally follow crude prices. So phenol prices would go up by, our expectation is by about 10 to 15 cents a kilo. And of course, in turn, the prices of hydroquinone also are going up. So we should be, there would be some gap in passing through maybe a couple of months, but the cost increase will be passed on.
Okay. So, okay. I have with me Amar Maurya also.
Hello.
Yes,
Hello.
Yes.
Yeah. Hi, sir. So just wanted to understand, like now the crude oil is also going up. Huh? Acha, puch liya. Okay. Then I'm done. Okay.
Thank you. The next question is from the line of Balwinder Singh from Canara HSBC Insurance. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. On the enabling resolution that you have taken of 250 crores, so just wanted to understand more because CAPEX that we are envisaging for FY19 and 20 is 240 crores. We had done QIP and raised around say 150 crores. So we would require not more than 100 crores, but you are taking an enabling resolution of 250 crores. So where is the disconnect?
No, so what we are talking about is CAPEX and there is working capital. So for CAPEX that we are doing in Dahej, the working capital requirement will be also about 100 crore rupees because the turnover from there would be in the region of 300 crores. So as we are seeing with the banking, in the banks right now, the problems that they're facing is we are not in a position to increase our facilities for working capital till such time as the banks settle down and they come back into the markets. So that is the reason why we are saying that we should be ready in the event that we require money for working capital as well. So for the QIP, 150 crores was raised where we had laid out exactly for what purpose we were raising the QIP. So the equity portion of the hedge for the project was 40 crores. For capitalizing the subsidiaries, we had 30 crores. For some maintenance capex, we had 20 crores. And then we had general corporate purpose, 60 crores, which was essentially part of the working capital requirements for our existing businesses. Therefore, with the new business of the capex that we are doing and the additional turnovers also in our existing businesses, we will require additional working capital. So that's the reason why we are looking at taking this enabling resolution where we should, if required, we should be able to raise 200 crores or so.
So the current gross debt is roughly around 350 crores?
Yes, 370.
317. What is the peak gross debt that will happen post the hedge?
So the peak we are looking at will be, say, it will be about 520 or so.
Okay, including working capital and everything. Okay. Coming to my next question, we are involved in so many geographies and currencies. So how do you manage FX risk, and what is the impact of rupee depreciation on your P&L account?
So on the FX, what we've seen over the last 3 to 4, 5 years, we have some natural hedges because we also buy in dollar and sell in dollar. The only place where we do get impacted is in Europe, where we are buying material in euros and selling in dollars. But the impact on foreign currency fluctuations, typically we see over a period of time kind of gets evened out. So in the last year, on a consolidated basis, we had a gain of 1 crore. Though in quarters you may see, in one quarter you may see an impact of 3-4 crores positive or negative. That is the first part. Second part, on the rupee depreciation, of course, that gives us a bit of a tailwind because of our exports most of our sales are in dollars, so that gives us a bit of a breather.
Okay. Thanks, I'm done.
Thank you. The next question is from the line of Jinesh Joshi from Prabhudas Lilladher. Please go ahead.
Hello?
Yes.
Thanks for the opportunity. The decision to let go Kemin was to forward integrate into blends. And if I heard you correctly on the call, the total revenue from blends increased from about 130 crores to about 200 crores in FY18. And this being a high margin product, what I fail to understand is that why the profitability numbers are not showing up despite the revenues which are increasing significantly on a year-over-year basis.
Yeah. So, I answered that question a little earlier when I gave the numbers for each of the subsidiaries. So, if you analyze, North America has a negative of 12 crores because the blends business is in a very early stage in North America right now. Then we have, because of the fixed cost that we run, the business follows a year after, it takes about a year and a half for you to break into those markets. So therefore, when you see that is a big impact, that on a 200 crore business, if your 12 crores is lost only in one geography, on the fixed cost, it has a big impact on the margins. Similarly, we were in Brazil, we are now reaching break-even. In Europe, we are slightly above break-even. So you will see the margin improvement as the turnover starts increasing in that geography, in that region, you start seeing the margins improving. So like Mexico is an example where the margins are anything between 18% to 20% is typically the EBITDA margin. Once we reach in each of these geographies where we reach, a turnover of $10 million on blends, you start hitting these numbers, the margin.
Okay, but if I recollect properly, Kemin contributed roughly 90 crores to the overall top line, and this being a low margin business, despite that we were able to kind of rake in decent margins and report profits. Now the size of the business has doubled from 90 crores. I mean, you lost 90 crores because of Kemin going out, but now you have kind of compensated that by increasing revenues of 200 crores. And blend is a high margin product as compared to TBHQ and BHA. Yet what I feel is that the overall fixed cost which is involved in these geographies is significantly higher to kind of recoup these losses which we are incurring. So in hindsight, does the decision to kind of move into blends is not playing out as per you, or do you think that it will require a further scale and a longer timeline to break even?
So again, I'll repeat. I mentioned that earlier the last time to you, is that at $10 million, we make a 20% EBITDA margin. The gross margins are all 40%. Yeah? So if I'm doing a business in Brazil of 5 million at a gross margin of 40%, gross margin is 2 million, but my fixed costs are 6 million. So I'm losing 4 million there. Right? So it's a question of reaching scale and size on each of the geographies that we are in. So in each of these, now we are reaching, so we know that in Brazil this year, we will start seeing the margins improving. So when the total margin, so if I was to say 2 years from now, if you were to look at our business, if we are doing 60 crores in Brazil or 70 crores in Brazil, if you will have a 20% margin there. Similarly, North America will have a 20% margin. So the whole, this is the time that we are investing money, and we have invested in the past, last year as well, and the year before that we started this process when we moved away from Kemin. We believe in the next 12 to 24 months, you will see a significant uptick in the margins from the blends business.
So to answer your question, the decision was absolutely right. Very clear.
Sure. So at what revenue level of blends will we break even, and at what revenue level will we be able to get a higher margin?
No, so we are above break even today on the blend business.
At the EBITDA level, I'm talking about the EBITDA level.
Yes. At EBITDA level, on a consolidated 200 crores business, we are above break even.
Okay. Thank you.
Now, and to make it, to go to 20%, yes, at 270 crores, you'll start seeing a much better number. At 350 crores, you'll see a far superior number.
Sure. Okay. Thanks a lot.
Thank you. The next question is from the line of Ravi Mehta from Deep Financials. Please go ahead.
Yeah, hi. Thanks for the opportunity. My question is more on gross margin improvement sequentially. So I think you answered partly, but it remains unanswered, is that the console gross margin improvement is lower than the standalone.
Yeah.
So last quarter, I think you had a hit in Guaiacol price discovery, so you had a bad gross margin in standalone.
Correct.
Which seems to be recovered in Q4. But when I look at console gross margin improvement, it is some 16 crores QOQ improvement, whereas standalone is 18.8, so close to 19.
Right.
So console, I thought even you will be having a better gross margin in vanillin because that was also being sold at a lower price last quarter. So where is the disconnect, if you can explain?
In the vanillin, any which ways on the Guaiacol, in the consolidated, there was, that got, in the last quarter, that in the consolidated gave advantage to the China side. However, the margins in this quarter versus the previous quarter in China, yes, the prices of vanillin have gone up by about 7, 8 to 10%. However, some costs also on the raw material side, we've seen, especially on the caustic lye, on glycolic acid. In China, some prices of raw materials have also gone up. So it's kind of the cost increase that we saw in some of the raw materials was more or less corresponding to the price increases that we were getting.
Okay, so in that case, at least the gross margin improvement could have been equal to standalone. Is that a fair understanding?
Sorry, what? No, I didn't follow you.
So whatever increased gross margin we can make in the standalone business from Guaiacol, at least that will be captured in the console numbers?
Yes, of course.
Okay, so that's why there is a disconnect of 3 crores, so I was just trying to figure out. And Chinese facility would be making what kind of margins if the other raw material input prices are going up? But the vanillin prices are also going up, so...
So on the gross margin, we are at 22% for the financial year, 21.06%.
Okay.
That's the gross margin. On EBITDA level, of course, because of the capacity utilization, it's 60%. But this 20%, we are hoping that we should be able to take it up to about 22, 23 during the year, because some raw material prices we are seeing that will ease off, especially on the caustic side, because supplies are improving. And also the market prices of vanillin are also improving slightly. So maybe we have a 1 or 2% there that we could improve on the gross.
So FY19 EBITDA can be 15-16% from these from the Chinese facility?
Not only from the Chinese. See, on a standalone basis, you will not get it, but now we have a margin in supply of Guaiacol.
Yeah.
So when you combine the two, yes, it would be that region.
Okay.
It could get to, but for that we need to reach the 75% capacity utilization.
Okay. And the other question was on employee expense. Last quarter you explained there was some one-off bonus being paid, but I still see the sequential number higher. So what explains that?
There was also an increment in last quarter, and it came in sometime in October. In this quarter, it came for the whole 3 months. That's that increase.
So, when the console employee cost going up from 18.5 to 20.4, so that is a new run rate we should track?
Yeah.
Yes.
Yeah. 20.
Okay. And one question was on the Forex impact. So I think I heard you saying there is some 7.5 crore impact in the other expense from Forex.
Not 7.5.
So can you please repeat that? Sorry.
So there is a impact of around 3 on Mexico and Brazil of around 3.5 crores out of the increase of 9 crores. And the balance 2-3 crores has come because of China working at a higher capacity in this quarter.
And there was a foreign exchange gain in India.
So there was a corresponding foreign exchange gain which has got clubbed in India at other income level.
Okay. Because Santosh, last quarter you said that strong INR led to some debtors repricing and 4 crore hit which is sitting in other expense. So I was just looking at the currency was actually softer in this quarter. So was there any reversal?
We got 2 crore rupees of credit because of that.
Okay. And still 3.5 crore hit in Mexico?
In Mexico and Brazil.
Okay. Okay, fine. And fine, I'm done. Yeah, thanks.
Thank you. The next question is from the line of Bhavesh Jain from Envision Capital. Please go ahead.
So is it possible to share gross profit margin and EBITDA margin for this quarter for all the subsidiaries?
Hold on.
For this quarter?
Yeah, for this quarter.
So for Europe it was around 40% gross margin and around 1% of EBITDA. We had a negative profit before tax of around 54 lakhs there. In Brazil, we had 34% gross margin, but EBITDA, since we had a foreign exchange and other losses, it was 1.57 loss, so a negative EBITDA of 0.26. We had a PBT of 2 crores minus. In North America, we had a gross margin of around 13%, but because of the fixed cost, we had a negative 3 crore EBITDA and almost equivalent profit before loss before tax. In Mexico, we had 44% gross margin with around 17% EBITDA and a 7 crore profit before tax. In China, we did around 20% gross margin and EBITDA was at 3% because of the capacity utilization. We made a very small profit in this quarter.
Okay, sir. Thanks a lot.
Thank you. The next question is from the line of Nikhil Mathur from Ambit Capital. Please go ahead.
Yep. Thank you so much for the opportunity. I have a couple of questions. The first question is on the vanillin business. So where do you see the supply-demand balance heading in the vanillin business globally? Are there any major capex plans being executed by companies like Solvay, or is the market likely to head into a tighter territory in the next couple of years or so?
So there is no new capacity which is being set up by Solvay or, for that matter, any of the other existing players. I think the market will get balanced in the next 1 to 2 years. So demand supply should more or less match. What we are seeing is some of the producers, one of the bigger producers in China had to reduce his capacity because of environmental reasons. And I don't think that they would be in a position to bring back the lost capacity in the very near future. So the market should be balanced for the next few years.
So what is the peak gross margin that has been seen in the vanillin business globally in the last 10-12 years? I know that Camlin is the recent entrant in this business, but what have been the previous peaks in this business as far as gross margins go?
So gross margins, see again, we have it's an integrated business with guaiacol being produced by us, catechol produced by us. So it's difficult to say because some of the other producers are not necessarily integrated. But if you were fully integrated, I think the gross margins would be about 30% or so.
Okay. And also, sir, on the blends business, so previously, when the company was a two-product company, your gross margins went up as high as 55-58% 3-4 years back. But what is holding back the gross margins in blends? I mean, overall gross margins, apart from Mexico, in the other geographies, they are lagging. They're even sub 35% levels in many geographies. So why are the margins in blends not being realized to what possibly could be envisaged?
No, I mean, I think I answered that when Jinesh asked the question on the blends business, because in different geographies, we are at a different level of progression. So wherever we are, the blends turnover is in excess of certain amount, the margin starts improving because there are certain fixed costs that are involved in the blends business.
But sir, I'm talking about on the gross level, not on the EBITDA level.
On gross level, it is more or less it's starting at 35% and going up, upwards of 35.
Okay. And finally, sir, on the Lockheed business, any firm indications yet from the Lockheed Martin business, how it is likely to pan out in the next couple of years? Can you share some?
So there is, they're basically going ahead with their program the way we've envisaged it. We've done part of the basic engineering is completed. We're doing some cost analysis on the project cost, and I think in the next few months we should arrive at what that project cost will be, and as well as start working with Lockheed Martin on trying to execute that project. Yeah. So it's on track, and we are supplying some material. Again, this quarter we supplied them about 40 tons of material. In this year again, we will supply them some material from our existing facility.
Okay. And so one final question. So on the current business, whatever the capacities are, without taking into any capacity additions in the next couple of years, what is the peak sales potential that you see from at a console level from the current capacity that you have?
On the current capacity, that is without our Dahej expansion.
Yep.
So there, I think we should be with the blends business. We don't have any capacity constraint because it's not really a capacity-driven business. It's more selling. So we could easily add to the blends business in the next 3 years about 150 crores. In the vanillin business, we could add annually at least about another 150 crores. And on our other products, another maybe 30-40 crores. So we potentially could be doing about 1,000 to 1,100 crores without any capex.
Sorry, 1,000?
To 1,100.
Okay. Okay, sure. Thanks a lot. So that's all from my end.
Thank you.
Thank you.
The next question is from the line of Raghav Mittal from Locus Investments. Please go ahead.
Hi, thank you for taking my question. I had a couple of questions. First, on the performance chemical side, could you please give
Not able to hear you. Could you please be louder? We can't hear you.
Hello, am I audible now?
Yeah. Yes.
Yeah, sorry. So, just on the performance chemicals business, can you give the revenue of this year versus last year?
Yeah. Sure. Hold on.
And also the quarter?
Yeah, so on a consolidated basis, last year was 215 crores. This year was 245. So it's about 12.6% growth.
Okay.
Last quarter.
And you want the quarter-wise?
Did you say you wanted the last quarter also? No.
Yeah, the fourth quarter FY18 and fourth quarter FY17.
One moment. 50 crores in the last quarter and 60 crores in this quarter.
50 crores last quarter and 60 crores this quarter.
Yeah.
Got it. And just on the aroma side, the number which you gave for FY18 was 109 crores?
No, this is 88 crores.
88 crores.
One moment, I'll reconfirm it.
23 crores.
So it was 109.
109 crores.
Correct.
Huh? No, but that is not vanillin only. That is other. There are other businesses also, other aroma products as well.
Yeah, that's total for aroma.
Okay, so 88 came from China and 109 was the total. Prior to China.
Out of which 88 came from China.
Yeah. And we have some other products other than vanillin. We do some ethyl vanillin and one or two other smaller products.
But major is vanillin.
Okay. And the blends business, we did 52 crores this quarter. And what was the corresponding number for the fourth quarter FY17?
No, we don't have that one here.
We'll have to compile that. It'll take. It's not.
Okay. No worries. And just one last clarification. I think there was some disturbance in my line. You said that the gross margins, maximum gross margins for a pure vanillin player can be as high as 20%?
30%.
For an integrated.
30%.
Okay.
Player, starting from catechol.
Okay. Understood. Thank you so much.
Thank you.
Thank you. The next question is from the line of Anil Shah, an individual investor. Please go ahead.
Hello.
Yeah.
Yeah, so I'm new to the company, so would like to really know how do you divide the Camlin group into, like, is it antioxidants, performance chemicals? Can you just give us a brief as to how do I divide this company into what are the products?
That will take some time, so I'm not sure whether we should go into detail right now because there's limited time here.
All right, so sure, is it possible to come and meet any person in your company who can explain this?
Sure, you can set up an appointment with us.
Sure.
You can call our CFO and he'll try to set up.
Sure, thank you so much.
Yeah. Thanks.
Thank you. The next question is from the line of Anand Dubey, an individual investor. Please go ahead.
Hello, sir.
Yeah.
Sir, just I'm asking, how do you see the EBITDA margin in FY19?
On a consolidated basis?
Yes, sir.
Yeah, so I think we are looking at between 8 to 10%.
Okay. Sir, how do you see the top line in FY19 in consolidated basis?
It should be in the region of 850 to 900 crores.
And related to, sir, rate of interest of debt, how much rate of interest you borrow money?
An average rate of around 9.5% on a consolidated basis.
Okay. Okay, thank you so much.
Thank you. The next question is from the line of Preetham Lunawat, an individual investor. Please go ahead.
Sir, my question has already been answered, so the next question can be taken.
Thank you. Participants who would like to ask questions may press star, then 1. As there are no further questions from the participants, I would now like to hand the conference over to Mr. Surya Patra from Phillip Capital India Private Limited for closing comments.
Couple of questions on it. So, any update on the Lockheed Martin, the project cost, sir?
No.
It's supposed to...
No, it's too early as yet because the basic engineering is not completed. It's in the process of being done.
Okay, so it will be finalized by like...
By in the next 2-3 months, 2 months I think.
Okay, so then we are, despite that, we will be on track for our completion of the Hayes project by third quarter of current or end of the current calendar year.
Yes, yeah. So the Hayes for hydroquinone catechol, which is the Hayes project, we should be looking at commissioning in the Q4. So that's the first quarter of the next calendar year.
Okay.
So the construction is on, and I think all our long lead items have been ordered. By October, we should start getting all the long lead items in.
Yeah.
And commissioning should start in January.
Okay. And till that time, what can really, or which is the key trigger which will have a kind of a positive impact on the margin performance front? See whether it is the progression on the blend side, or what can drive the.
There are three triggers. One is on the blend side. As the revenue increases, it will add straight to the margin.
Yeah.
Because the fixed costs are not going up.
Of course, yes.
Then second is better capacity utilization in vanillin, which means we have to, and we are doing that. We are working on trying to open up each and every market for vanillin. And as those markets start, and our product gets acceptance and starts moving into those markets, better capacity utilization will give us a better margin in the vanillin business. And in the performance chemicals business, we are seeing some improvement in prices of hydroquinone, which could be one of the factors for improving the margin, as well as the currency. If the euro versus dollar remains weak, that should also give us some kind of tailwind.
Okay. On the blend side, what is the progression that you are, or what is the update on the US and European blends business front, and what progression that you are visualizing there? Because we are supposed to see incremental revenue from US and European.
So Europe actually has happened much faster than the US. The progress there, because we got a good opportunity. As a competing product with BHA, Toxiquin, which is a competing antioxidant, was banned in Europe for use in animal feed business. So some of those end-use applications, especially in the aqua feed market, BHA is a very good replacement for Toxiquin. So we got a good position there very quickly in Europe after the ban was implemented. Late last year, early this year. So Europe, I think, has moved much faster than the US. US, we are in the midst of now, in all the three lines, whether it is food, animal nutrition, or pet food. I think, we're talking to all the big guys, as well as we are appointing distributors. So you will see a movement in the US market in the next couple of quarters. It will start showing results of all the work that we've done in the last 1 year.
As of now, there is no blend revenue from the US.
It's there, but small, very small. It's about 1 crore or so.
Okay. Just one last question about the vanilla business. So when we acquired, it was the revenue mix of vanilla. If we consider, then it was almost like Chinese revenue only. Now I think you have started using your platform other part of the world for selling vanilla. So what is the current mix vanilla revenue, China and non-China?
So in China, we are selling about, I would say about 10%.
That's it?
Yeah, in China.
Okay.
And the rest is all export. So whether it is directly or through our platforms, or even we have some distributors that we sell to or traders that we sell to, it's all outside of China.
So that is the last question, sir. Right. So thanks a lot for your time and giving us an opportunity to host the call. Thank you all the participants for taking time out and participating in the conference call.
Thank you. Thank you.